Welcome to our explainer. Today, we are cracking open one of the most brilliant, most talked about, and, most controversial corporate tax strategies ever invented. We're going to find out how $1 billion can just disappear.
So take a look at this number, 0. That's the amount of corporate tax some of the biggest companies in the world have actually paid in certain countries, in certain years, all while making billions and billions in pure profit. I know what you're thinking. How is that legal, right? How on earth is that possible? Well, the answer lies in this incredible piece of financial engineering, a strategy with a name that honestly sounds more like a drink you'd order at a pub, the double Irish with a Dutch sandwich. All right, let's get into it. Okay, so first things first. To understand why this whole thing was even created, you have to see the problem from the company's side. For them, it was pretty simple. They were making a ton of money in major markets like the US and Europe, and high corporate tax rates were taking a big bite out of those profits. The entire solution they came up with is built around one thing: intellectual property, or IP. Just think of it as the company's secret sauce, the code for your favorite app, the patent on some new gadget, the power of a brand name everyone knows. This IP, that's the golden goose. It's where all the real value and all the profit really comes from.
Now, you can't pull off a plan this complex all by yourself. It takes a whole network of companies that are set up very carefully, like a special crew where every single member has a very specific job to do. And their one shared goal? To move profits out of high-tax countries and into no-tax havens, all while staying on the right side of the law. So here are the 4 key players in this whole global shell game. It all starts with the U.S. parent company. That's the brains of the operation. Then you've got 2 different Irish companies. We'll just call them Company A and Company B. And squeezed right there in the middle, you have a company in the Netherlands. This is often just a shell company that exists on paper, and that's the Dutch sandwich that makes this whole recipe work. All right, so the stage is set, the players are all in position. Now it's time for the main event, the great profit escape. This is how billions of dollars, made from customers like you and me all over the world, start a journey that's designed to end in a place where the taxman just can't touch them. The first move is a really big one. The U.S. parent company transfers the ownership of its super valuable secret sauce, that IP we were talking about, over to its subsidiary, Irish Company A. This one move kicks the entire thing off. The golden goose has officially flown the coop.
So what happens then? Well, anytime the company sells something in, let's say, Germany or France or Japan, a huge chunk of that money has to be sent to Irish Company A as a royalty payment just for the right to use that IP. So the profits don't even stay where the sales were made. They get immediately funneled over to Ireland. And you can see the result of this pretty clearly on paper. A company can make enormous sales in a country, bringing in tons of revenue. But after they pay those giant royalty fees to their own Irish company, the taxable profit that's left behind is just tiny. Sometimes it's almost nothing at all.
The source material we're looking at explains this with a really great metaphor. It says it's like a company getting all the benefits of a country's entire infrastructure. Its educated workers, its stable laws, its roads and ports, but then contributing almost nothing back in taxes to help pay for it all. Okay, so now all that money is sitting in Ireland, which has a low but not zero corporate tax rate. The real goal is to get it to a true tax haven, somewhere like the Cayman Islands. But how do you get it out of Ireland without paying taxes? Well, this is where the magic of the Dutch sandwich comes in. Irish Company A sends all those royalty payments to that shell company in the Netherlands. Because of some special tax treaties within the EU, that payment isn't taxed. Then, almost immediately, the Dutch company sends the exact same money to our final player, Irish Company B. And here's the really brilliant part. Company B is registered in Ireland, but it's managed and controlled from a tax haven like the Caymans. And under Irish law back then, a company was only taxed where it was managed from, so boom, all the profits just landed in a tax-free paradise. So the end result is a company that's telling 2 totally different stories. The financial books for the company that's operating in the US or Europe make it look like they're barely making any money at all. But meanwhile, that offshore company over in the Caymans, it's sitting on a mountain of untaxed cash. Or, as the source material puts it more colorfully, they are balling. Now, this wasn't just some abstract numbers game for accountants. This strategy had massive, real-world impacts. It shifted hundreds of billions of dollars in tax revenue away from public services and started this huge debate about corporate responsibility and the fairness of the whole global tax system. And for years, this was all perfectly legal. It was a way for companies to just dramatically slash their tax bills. But as more and more people and politicians found out about it, the pressure started to build. And in 2015, Ireland finally agreed to close this loophole for any new companies. But it gave the companies already using it until 2020 to wind it down.
And that kind of leaves us with the big question at the heart of all this. Was the double Irish with the Dutch sandwich just a brilliant logical strategy where companies were just playing by the rules as they were written? Or does the fact that it could even exist prove that the international rules for taxes were fundamentally broken and desperately needed to be fixed? What do you think?